real estate's always location dependent, but I think
Yep.
over the next couple of years, it's going to be even more location dependent.
Jay is an entrepreneur, investor, advisor, author of a best-selling book, the book on flipping houses, and partner in Bar Down Investments. In the past 14 years, Jay has been involved in more than $150 million in real estate. He also holds strategic advisor roles in several companies. We are excited to welcome Jay Scott to Real Estate Hacking Live.
What's going on, Jay?
Hey, how's it going, Chris?
Good. Yeah, I mean, you're one of the folks out there that anytime you post something, I can expect two things. One, it's going to be ridiculously long, but two, it's going to be ridiculously valuable to actually finish it because it's so content rich and fairly, at least from my perspective, balanced as opposed to pushing a specific viewpoint. So I've always appreciated that, and I think folks will probably get some value out of this here. What are your thoughts going forward in the real estate market? Are we looking at a 2008 type scenario, which is one extreme, or is the music going to keep on playing loud and clear?
Yeah, so let me start with, I don't have a crystal ball. Nobody has a crystal ball. So anything I say, I could be wrong. I've been wrong plenty, and I'll be wrong plenty more in the future. So I can make my best guess. I can look at the data. First, I think we need to consider that when we talk about real estate, we're talking about, well, at least two things. We're talking about residential, single-family residential, or small residential. We're also talking about commercial. And I think it's important to make the distinction between the two because the way the thing we care about is values. I mean, obviously, as landlords, we care about rents as well, and we can talk about that separately. But when we talk about where's the market headed, in general, we're talking about where are values headed. And so when you're talking about values, the way we value residential, single family, and small multifamily deals is completely different than how we value larger multifamily or commercial deals. And so on the single family side, things are based on comps. If I live in a 2-story house that was built in 1995, that whatever, 3-bedroom, 2-bath, the value of that house is essentially going to be related to what did the last several 3-bedroom, 2-bath, 2-story houses built in the 90s sell for in my area. And so it doesn't matter whether I'm renting my house, it doesn't matter whether I'm renting out my house, it doesn't matter whether I own it, whatever. The value of my house is strictly based on what the other houses around me are doing. On the other hand, for commercial real estate, larger multifamily real estate, everything's based on income. It doesn't matter what the apartment complex down the street sold for. It doesn't matter what the self-storage facility next to me sold for. All that matters is how much income I'm generating, and also this thing called the cap rate, which is basically a multiplier in my area. And so typically, we're going to look at these two things very differently. Let's start on the residential side. So on the residential side, things are based, again, on comps, where other things are selling. What I see likely to happen over the next 6-12 months is actually not a whole lot. For the most part, and Tarek made a good point that throughout history, over the last 100 years, we don't typically see real estate dropping in value. Certainly, it's happened a couple times. It happened during the Great Depression, happened during the Great Recession back in 2008. It's happened a little bit back in the late 80s, early 90s. But for the most part, it's not driven by the same cycles as the general economy. Real estate doesn't tend to go down just because we're in a recession. So that's number one. But number two, if you look at 2008 and you want to compare to 2008, in 2008, we had a foundational crisis in real estate. There was a lending crisis. There was a bond crisis. There was a crisis with sellers who were getting these adjustable rate mortgages that were coming due. There was huge unemployment, which I'm not saying we won't have that now, but right now the employment sector is looking pretty strong. And so people were getting foreclosed on and they were being forced to refi and couldn't refi because lending was getting tight. We're not seeing that these days. For the most part, a lot of sellers or a lot of potential sellers, people that own their houses, they bought over the last couple of years when interest rates have been tremendously low. Houses have been tremendously affordable up until the last year or so. A lot of them have good jobs. A lot of them are working remotely. They're working in places where they want to live. They've bought their dream houses in their dream locations. And so sellers aren't, for the most part, in a situation where they're going to be forced to sell. And that's the difference between now and 2008. In 2008, a lot of people were forced to sell because they couldn't refinance. They couldn't support their loan payments because the interest rates were a lot higher. But we're not seeing that now. So what I think we're going to see on the residential side, the single family side, is we're going to see a whole lot fewer sellers who are desperate to sell. There are always going to be some buyers. And I think the number of buyers out there who are looking to buy, interested in buying, will kind of match the number of sellers who are forced to sell. And we'll see prices that for the most part stay the same. That said, obviously there are trends that we have to follow. There's population trends, there are employment trends, there are places where businesses are moving. And so I think real estate's always location dependent, but I think over the next couple of years, it's going to be even more location dependent. There are a lot of areas where people are moving out of, again, because we've gone from a 15% remote workers 2-3 years ago to over 25% remote workers now. So a whole lot of people are moving to places they want to live as opposed to where they have to live for their jobs. So we're going to see, and we have seen, a big migration from certain locations to other locations. We've seen this migration of businesses and employment from certain locations to other locations. And so what we're going to see is those places where people and businesses are leaving are going to tend to do maybe not so well. I'm not saying it's going to be a 2008 type event, but we're going to see softening. We'll probably see prices go down. We may even see rents go down for the first time in history. But then there are going to be other places where people are moving and businesses are moving. And I think those places are going to hold up really well. Do I think we're going to see continued growth over the next couple of years? Not like we've seen, maybe not at all. But I don't think we're going to see a drop in housing prices in places where people tend to be moving. So if you want to know where housing is going to do well, look at the population trends, look at the employment trends, look at places that have good employment diversity. Those places are likely to hold up. Now, then there's the commercial side of things. On the commercial side of things, it's mostly driven by two things: rent and mortgage. Other expenses obviously drive things. Inflation's high, so other expenses are going up. But rent and mortgage are the two big things. I think over the next couple of years, we're likely to see rent stay consistently strong. It's not going to grow at 5, 6, 7% like we've seen over the last couple of years, but we'll probably hit that historical growth of 2, 3%. And on the mortgage side, mortgages are likely to go up. So rates are going up. They're likely to continue going up through the end of this year. So we're going to see higher rates. And that's definitely going to tamper demand. It's certainly going to tamper values. But again, I don't think it's going to be a 2008 type event. I think for the most part, we're going to see fewer sellers who are desperate to sell or need to sell or want to sell. We're going to see fewer buyers out there. So I think we're going to look back in a year and we're going to say there's very little transaction volume, very few sales, but prices basically held up over that year.
Yeah, and that works well. We got a couple minutes left. That works well for the landlords. For transactional based, say realtors or brokers out there that are working in an environment with fewer transactions. So we had lower inventory. Can be fewer transactions, but now we have other factors that will reduce transactions. It's gonna force some folks to move into maybe spaces, maybe working more leases or referrals than they've had to do in the past. But on the commercial side, you were talking about, you got rents and debt service. The one thing that has been really good for operators is rents growing at a pretty good rate has been able to mitigate some of the debt service costs that they've had. And we'll see if that continues to trend. But ultimately, over the last 70 years, I looked this up, there was only 1 year that had negative year-over-year rent growth.
Yep.
Macro. Micro matters, but this is macro. And that was 2010. And I think it was only like 3 months out of 2010, and it was like 1%.
It was tremendously. If you look at it on a graph, you don't even notice it.
No. So it's promising from a macro level. Micro does matter, but it's definitely promising from a long haul. Things definitely change if you're talking about flipping short-term single family. It's a lot different there. So, all right, hey Jay, I think we need to get you on for like a full hour here. Appreciate it. If you don't follow Jay, definitely do his commentary. I don't know if you're doing it weekly or just whenever, but it's always really good on the market. So thanks again, Jay.
Appreciate it. Thanks, Chris.